All right. Hello, everyone. And before I jump into the training, my name is Min Chao. I'm a loan manager at Pacific Y for a while, more than 10 years here. And today, the purpose of the training is to help homeowner and real estate investor to save millions of dollars or 100,000 of dollars. When you invest in real estate, and the main goal is to bring in home as much profits as possible. So for me, this is really important because I am also a real estate investor myself, and I want to help people to bring home a lot of money for investing in real estate. And because when we don't know how to save money, how to keep money, we won't profit as much. Okay. And when you invest in anything, money is the goal. Number one goal is to gain more money. So today we talk about capital gains tax. Okay. All right. So we will going through the capital gains tax and 1031 exchange. The two topics will help you to save so much money. First of all, this is the content that we will go over. So we'll show you how to calculate capital gains, and then we'll talk about capital gain tax and how to minimize or eliminate capital gains tax for owner occupied and then for non-owner occupied. So this presentation is for both homeowners and for renters. I mean, for real estate investors. Okay. Uh, yeah, we talk about 1031 exchange, 1031 exchange, not 1030. 1031 exchange. Yeah. We'll talk about the short terms versus the long term capital gains tax. Which one is better? Which one to and you will understand what is long term, what is short term, and how much tax you're gonna pay for your capital gains tax at the end. You will have all the number to go home with. So at the beginning, I will just give you some definition of capital gain. So when you own a home for a certain time, like 2 year, 3 year, 5 years, or 10 years, your home value appreciates, right? And if you sell your home after many years, you live in it, you sell it, of course, the home value at the time you sell will be much higher than the home value at the time you just purchased, many years ago. And that is how much you made from that sale minus the cost basic. I will explain to you what the cost basic is, but that will be your capital gain. So your profit basically from selling the home, your net profit will be your capital gains. And we are living in the America right now, and everything you invest in and you gain some profits, definitely you will have to pay tax. But in real estate, there's a way for you to not pay tax at all, or you delay your tax until you want to pay it, or you can delay it forever. But how do we do that? We'll talk about it. But before we go there, we need to talk about all the definition, the formulas, so that you can do it yourself. You can figure it out yourself when you should sell a home, and how much you're going to make profit, and how you're going to avoid paying capital gains tax. You have to understand all this in order for you to help yourself or your friends and your families to save a lot of money from capital gains tax. Okay. So the selling price here is actually the total value from the sales before any expenses. For example, if you sell a home for $2.3 million, that is your selling price. I haven't, even though I know you have to pay for commission, you have to pay for a lot of legal fee, documents, paperwork, stuff like that. But we talk about selling price at this point, it's just the total price that you sell to your client and the buyer is paying for it. Okay, so the selling price is just a total value from the sale before any expenses. Okay, because of that, now we talk about the cost basic. Okay, the cost basic. Um, in this case, we talk about the owner occupied property, meaning you live in it. You never leave the house. You live in that house for many years. So the cost basic for this one would be, this is the follower. The original purchase price, the price that you purchased the home a long time ago, plus the closing costs you pay when you purchased the home long ago. Okay, for example, let me be easier to understand. For example, in 2010, you purchased a home for a million, no, for $500,000 in 2010, $500,000. And then your closing cost at that time is $5,000. So that original price 500, closing cost 5,000. And at that time, you bought a home at 500,000. You don't have to pay, you might spend some money on, replacing the carpet or upgrading your bathroom or painting the house again. The money that you spend replacing the carpet, painting the house, or remodel the bathroom, it won't be considered home improvement cost here because you did everything just because you want to live in a home that you like to, unless at that time when you just purchased a home and you decided to extend one more room with permit. And then the moment the room is added to the home value go up, and that home improvement cost will be included in here. So when you put money into the property to improve it, but you make it become valuable, like the value increase, then that called home improvement cost at the time you purchase it. Okay, but if you just use the money to make it nicer for you to enjoy to live in it, then it doesn't, you cannot include it in here when at the time of purchasing. But when you sell it now, you bought the property in 2010, okay, and now 2023 you sell it for $1.2 million. So back then you purchased for 500,000 plus 5,000 closing costs. There's no home improvement cost because you not really extended the home. You didn't do anything to improve the home value except just replacing the carpet and make the restroom more nice. That not home improvement cost. But now when you about to sell your home, you're going to sell the home right now in 2023. Before selling the home, because you've been living in there for so long, more than 10 years, you want to spend money, remodel the home so it looks better before you put it on the market so you can sell it at the best price. And now you spend $50,000 on remodeling the home. And this time, with that $50,000 you spend on the home will be your home improvement cost. And you can put it in this formula. Okay, so you have to remember the home improvement cost this second time before you sell it, because you want to sell it at a higher price. So whenever you put in money to make the home increase in value, that's your home improvement cost that you can put in here. And then when you sell home, you have to pay commission for the buyer agent and the listing agent. You can put it in here, and all the fee you have to pay for title and escrow, anything related to the sale. Even you hire the interior design to come and staging the home, or anything. You have to order inspection for the home before you sell it. Anything you have to spend at this time will be added into this formula. So that is your cost basic for owner-occupied property. The definition of owner-occupied properties is you live in it. That's it. You have to live in it. That's your home. You live in that property. Okay. So the formula of capital gains is just the selling price minus the cost basic. In this case, we talk about the owner occupied property. And then the capital gains tax is actually the tax that the government will tax the homeowners on their profit. So for example, in this case, the original purchase price is 500,000. The closing cost is 5,000. Home improvement 50,000. So it's 555,000, assuming commission and legal asset, everything like that. Maybe 40 something thousand together. It's 600,000 total. This is just some number. Okay, don't quote me on this one. So total cost basic in this case is 600,000. And the home was sold in 2023 at 1.2 million. So in this case, the selling price 1.2 million minus the cost basic 600. So the capital gains in this case is 600,000. Okay, so that is the capital gains. The whole purpose of this slide is to explain to you how do you calculate the capital gains. Okay, and of course, we're gonna talk about, because this person gained 600,000 in this case, how much do they have to pay tax for the capital gains tax? I'm gonna go to the next slide. In the next slide, we talk about capital gains tax for owner occupied. So if there is a one individual own a property, if they live in the home for more than 2 years, So this is a capital gains tax exemption. You have to remember the rules. You have to live in the home for more than 2 years. And then after that, you sell the home. For an individual, you get 250,000 capital gains tax exemption. Okay, for more than 2 years. Remember, you have to live in the property for more than 2 years. And if there's a couple of husband and wife living in a home for more than 2 years, after many years living in there, they sell the home, they get to have 500,000 capital gains tax exemption. In the example in the previous slide, we talk about they have 600,000 capital gains tax. And assuming that's a couple, they own the home together and they lived there since 2010 to 2023. That means they lived there for 13 years. In this case, how much do they get exemption from? 500,000 exemption. Okay, so their capital gains tax is 600,000, but they got 500,000 tax exemption on capital gains. Then they only have to pay capital gains tax on 100,000. Okay, so this is awesome because 500,000, if they have to pay tax on capital gains on all 600,000, that's a lot of money. But because they got 500,000 exemption, they only have to pay 100,000 on capital gains tax. Okay, so you need to remember this. So that is why in the US, every 5 years or 7 years, homeowners sell their home because of this reason. They have to move because of this reason. They want to put the 500,000 tax exemption on capital gains in their pocket. If they stay longer, they still only get 500,000 tax exemption. If somebody live in a home for so long and the capital gains is like $1 million, they only get 500,000 exemption and they have to pay tax on 500,000. That is so much. They lose so much money. How about every 5 or 7 years, if they see, oh, if I sell the home right now, I know how to do the calculation. I know how to calculate the capital gains. I know how much I gained. Okay, the moment I gain more than 500,000, I move. If somebody keep doing this 4 times in their lifetime, guess what? They save $2 million. $2 million without paying tax. That is a lot of money. But I've been seeing a lot of people because they don't know this. They stay in their one home for 30 years. I remember long time ago when I still going around knocking on door, and I went to the area, one of the area in Sunnyvale. I met so many homeowners. They live in there for more than 30 years. And I asked them, how much did you pay for your home 30 years ago? Or more than 30 years ago, the time you purchased the home. They said 30,000. And you guess what? Their home value at that time when I knocked on their door was 1.4 million. And they stuck in the house because right now they retire people. And if they move, first of all, if they move right now, they sell the home, they will see they have to pay so much tax, even though they get 500,000 exemption, but they still pay so much tax on the rest of the gains. Not only that, one more issue that stopped them from moving. They bought the home at 30,000. Guess what is their capital property tax? Really low property tax. If they sell that home and if buy another one, doesn't matter how cheap the house gonna be, the property tax will be more, right? Some people they okay. We talk about Prop 19 next time. For people who over 55 years old, you can get transfer your tax rate over to the next place. But at that time, um, the tax the property tax was rule or guided by a different kind of rule, like only county to count, like within the county you can transfer property tax, but now we can transfer property tax rate everywhere. We'll talk about that next time. We're not going to confuse you this time, but for people who stay in the home for so long, they don't want to sell their home. They are mostly stuck in their home because of the capital gains tax. Okay. So because you understand this, you are in this class, you understand this. I hope you are gonna save so much money and you're gonna make so much money on your real estate investment. Okay. If you have any question, you can always put in the chat. I think I have somebody put in. Okay. Okay. Uh, I don't. Okay. Somebody can talk. Okay. Somebody can talk. Okay. That's fine. If you can chat if you have a question. Otherwise, I'm gonna go to the next slide, gonna be example, okay? So in this example, I just give you the numbers so it's easy for you to follow whatever I've been talking about. So Scott and his wife bought a house for 300,000, okay, in 2012. Let me see somebody chat here. Thank you, Tuan, for joining in and thank you for your comments. I appreciate that. So Scott and his wife bought a home for 300,000 in 2012 to live in it as an owner-occupied property, and they paid $2,000 for closing costs. The house was sold for 900,000 in 2020. Okay. Home improvement was 50,000 before the home was listed on the market for sale in October 2020. So they bought a home in 300,000 in 2012, and then they sold it in 2020. But before they listed the home for sale in 2020, they spend money 50,000 on remodeling the home because they want to sell the home at the best price. Remember this. Every dollar you put in the home to remodel it or to make it look better or to make it function better, you will get $2 back. Normally that's how it works. Because when you sell a home and then you don't fix it, you don't do anything, you don't make as much money when you put in some money. Okay. Just remember that's the money you put in to remodel your home before you sell is your investment to get you more money, to gain you more profit, basically. And of course, when you sell the property, you have to pay commission for the selling agent, for the listing agent, just a rough estimate is 54,000. And then, all the inspections for the home before you sell it. You have to do the inspection on the physical inspection, termite inspection, all that kind of inspection. And you also do internal, like staging the home. You hire actually at Pacific Y, we do all that service. We hire people for you. We plan everything for you as a home as a seller. You don't have to do much, but then our agent will show you what they're gonna get done for you. But they're gonna hire people to like come to your house, to make it nicer, fix it or whatever, or hire interior design to stage the house so it look the best when we sell it. So all that money throw in there like $10,000. That 10,000 include escrow fee, title, county fee, all kind of things. Why I give you all this number? Because I want you to use the formula here to calculate your capital gains. So use this example. So we would just plug in the number, guys. So the original purchase price is the home that the price that they purchased in 2012 is 300,000. You plug in that number, 300,000 right there. Closing cost 2,000, and then home improvement cost in this case, because they put in the money to improve the value of the home, to sell it at a better price. So that is called home improvement cost. And at 50,000, you put it in there. And then commission and legal fees, 54,000 and 10,000. Okay. Remember, when you do home improvement, make sure you hire one company and do all together. So you come out with like all the receipt come out from one company. It's easier for you when you have to deal with the IRS, because if you have like 10 different receipt from 10 different company, it's a little bit hard when you deal with the IRS, when you try to explain to them your your cost basic. So it's this is from our own experience. When we use one company, it's way easier than you many different company when you do home improvement. Okay, so when we add up all that number, the total of cost basic come out at 416,000. So the selling price is 900 minus the cost basic 416,000. So the capital gains in this case 484,000. So Scott and his wife, they own the property together, and this is their owner occupied. Do you remember the tax exemption? How much tax exemption do they have in this case? For a couple, remember the previous slide? For a couple who own a property more than 2 years, they have 500,000 capital gains tax exemption. So in this case, 484,000 is less than 500,000. What does it mean? They don't have to pay any tax in this case. You see that? You see how awesome it is? They don't have to pay any tax at all in this case. All right. So, any question? If no, I can move on to the next one. So we just basically cover the capital gains tax exemption for a couple. In this case, they bring home 484,000 without paying a dollar for tax. This is amazing. I love real estate because how it is. It makes people, more wealthy. So the more you will invest in real estate, the more you be good for yourself. Okay? Okay. Now we talk about rental property. The same formula for capital gains. This is how you calculate capital gains. Capital gains equal to the selling price minus the cost basic. That's it. And the selling price is the total value from the sale before any expenses, just the sale price. If the buyer pay you 900,000, that's the sale price. That's it. No expenses, because the expenses will be covered in the cost basic. Okay. In the cost basic for the rental property, you see something different. Everything else looks exactly the same, but the only difference is the claim depreciation. Okay, claim depreciation. What is the claim? What is the depreciation in this case? Okay, I have the definition down right there. Real estate depreciation refers to the deductions in the value of real estate. Everything tear and wears after years and years, right? Human being, how do we get tear and wear? We get older, right? We're sick, we get wrinkle. That's how human beings get tear and wears. But property also get tear and wears, So, but this is the beautiful about rental property. You can claim tax on every single thing. It's beautiful. We can talk about tax. I can talk about in the next training, or in another training. I will talk about the Schedule E, how you file tax on your real estate investment. You file tax on everything: home insurance, mortgage interest, property tax. HOA, the money you put in the home to prepare to fix it up, you can file tax too. Everything, every single thing, and more than that, depreciation. Come on, depreciation. What is the number of depreciation? There is a formula for depreciation. You just put it in there. I think I remember. I don't want to talk about it because I don't want to confuse anyone. But anyway, for somebody who owns an investment property, in your tax return, in your ski under your Schedule E, beside all the thing like mortgage interest, property tax, insurance, prepare, HOA, whatever you have to pay, you can always claim depreciation. And depreciation it actually help you to reduce the amount of tax you have to pay to Uncle Sam. That's it. So because you already deducted during the year you own the property and you rent it out, so now you cannot include it in your cost basic, but you have to take it away. So that has to be in there. Okay. All right. So capital gains tax will be taxed on whatever left on so the capital gains equal equal to the selling price minus the cost basic. So we will take a look at capital gains tax, but for homeowner you have exemption like 500,000 for a couple and 250,000 for an individual. How about for rental property? Is there any tax exemption? Is there any way to avoid capital gains tax? Bad news, there is no tax exemption on rental property. Okay, that's the bad news. Okay, but there is a good news. There is a 1031 exchange. Okay, let me show you the 1031 exchange. For the 1031 exchange, it's allowed a real estate investor to delay their capital gains tax. Remember, delay, okay, delay. How do we get to do this? Okay, for example, if you own a property for 5 years, whatever number it is, you've owned it for 5 years. You've been renting it out, and now you want to sell it because you see you make so much profit out of the property, you sell it. But normally when you sell the rental property at closing, before like you give the key to the buyer, the title company will hold portion of the profit that you make from selling the property at your capital gains tax. They hold it right then and then. You won't bring everything home. Why do they hold your money? Because they will pay for that will be part of your capital gains tax that you will pay later. And nobody want the title company to hold our money. I don't want them to hold my money. Oh my God, that's a lot of money. Because nowadays, a property, if you hold it for like 5 years, 10 years, you gain at least $500,000. And you don't want them to hold like so much money. I don't even know how much money they can hold. Maybe 35% of your profit. Think about it. It's a lot of money if they hold back. So the 1031 exchange is something so awesome. But it makes us to continue investing. Okay. One thing about it is you don't have to pay tax, but you have to continue investing in real estate. Okay. If you sell this property and you don't want to pay tax on it, you want to delay tax, you buy another property and they give you 45 days to be in contract of the new property. You have to be in contract before that 45 days. So the day you give the key to your buyer to the day that you are in contract of the new property, there is only 45 days. And remember, 45 days is not a long time. And it takes time to find a new property. So my suggestion is the moment you put the property on the market for sale, you look for the property. Okay. Look for the property. If you're in contract before you sell the property, that's fine. but you have to let the other knows that, hey, I'm doing 1031 exchange. I need time. Okay. And if the seller is okay with your time, that's okay. Or you can just, if you have the down payment, you go ahead, do it. And even though you're done with the new purchase and then you close your sale transaction, you can still do the 1031 exchange, no problem. But because I had, experience when we done selling the property, when we gave the key to our buyer, we have 45 days. We were so stressed. We were so stressed out because 45 days was going so fast. You have to look for something you really like, right? And it has to be under your budget, right? And you only have that many days. I was so stressed when I purchased my new purchase with that 45 days time. So my suggestion is to start looking at the moment you're thinking of selling the property, okay? But you have 6 months to close the transaction. But normally you only need 6 months to close the transaction when you purchase a commercial property because it takes longer. But for a residential property, you close within 30 days. So they give you 190 days, 180 days uh, from the day you give the key to the buyer to the day you're closing the new purchase is 180 days. That's a lot of time. But the 45 days is not so much, okay? Because searching for a property and find what you like take a longer time. Okay. All right. Must purchase another like kind property. So if you are selling real estate property, you have to purchase a real estate property. For example, you can sell the single family home and purchase a duplex, or you can sell a single family home or purchase a fourplex, or you can even purchase a commercial property, no problem. But you cannot sell a single family home and purchase a boat. You cannot do that. You have to sell, when you sell property, you have to buy property, real property. You cannot sell real property and purchase a personal property. A boat, an airplane is a personal property, but real estate is a building, okay, building. You can buy single family home, duplex, commercial, no problem. It have to be building, okay? When we're talking about real estate right now, so it have to be real estate. The replacement property must be of equal or greater value. If you're selling a $2 million home, now you have to purchase something $2 million or more. And sometimes when you sell a property for $2 million and you have so much money in it, but you don't want to end up buying another, just one other property for $2 million. You can buy two property or three property from that $2 million. For example, you sold the property for $2 million, right? And then at the end you bring home like $1.8 million in liquid asset in cash. So you might think of, okay, I'm gonna buy three homes. Each home might be more than $1 million, but I will put down the down payment, whatever amount that fit, and then the rest I will loan. I will borrow money. That's fine. Or you can buy five homes, or you don't need to go there. You don't have to buy five homes or three homes. You have $1.8 million liquid asset, and then you buy a commercial property for $5 million. That's fine. That can be an apartment building, 30 unit or 50 units. You put in 1.8 million at your down payment, and you buying a apartment for 30 units, and you loan the rest. That's fine. So that the 1031 exchange is a way to help us to increase our level of investment in real estate. At the beginning, you might invest in one house, and then later on you invest in a duplex, and then later on when you sell the duplex, you invest in the fourplex, and then later on you can sell the fourplex and invest into an apartment. So in 1031 exchange is a really awesome tool. At the end you have, for example, at the end you own an apartment, right? And that will be your income when you retire, and you can retire anytime you want to. Real estate investment will help us to retire early. That's what I love about real estate, okay? And when you retire early, you don't have to just stay home doing nothing. You can travel the world. You can Do whatever you like doing. I can't wait to that day, I can't wait to travel the world and do what I want to do. So 1031 exchange is one way to help you to be wealthy in finance, okay, in terms of money. Okay. Must invest all of the proceeds from the sale, must be the same title holder. Okay. So whatever amount you sell from the property that you just sell it, you have to use it for the new purchase. You cannot hold back anything because then any amount you hold, you keep, you have to pay capital gains tax on that amount. Okay. So you don't want to do that. Must be the same title holder. For example, you and your husband sell the rental property and you guys purchase another duplex or fourplex, you your name and your husband name or your spouse name have to be on the new purchase on the fourplex. You cannot add anybody name on it. Just you two, whoever on the title of the first property that you just sold have to go to the next one. So have to be the same title, same people. In one case, I have a brother and sister. They own a property together for a while for rental, and then they sell that property. They buy another one. When they bought the property together, none of them married. But now they buy a new one. They want to put their spouse on the title, but that doesn't allow. So again, the brother and the sister go on to the title of the new property. Okay, so that's the only thing. Okay, one thing I want to share with you. If you might ask me, oh, when do I have to pay the capital gains tax in this case? If you if you sell one and you purchase another one using 1031 exchange, and if the second one you sell it, you will have to pay capital gains tax on the first one and on the second one. Okay. How do you avoid that completely? Okay. You keep buying. So you sell this one, you purchase another one, 1031 exchange, and then when you sell this one, you purchase another one using 1031 exchange. You keep doing that until you passed away. Guess what? All the property you purchased later on using 1031 exchange, and you give all of it to your children, you don't have to pay a dollar for capital gains tax. And your child, they don't have to pay a dollar for all the tax that you've been delaying. Is that awesome? That's how you completely don't have to pay any capital gains tax for investment property. This is the game. This is how you should do it. So to me, the best way is to keep buying, extend it so that you have all that lined up for your retirements, and then your children will continue. Is that beautiful? It's beautiful, right? Okay, we'll talk about property, more tax next time, and we'll talk about Prop 19 next time. Okay, I don't see any questions, so I will continue on to the example. So this example is very easy. It's almost similar to the other one. So in this case, Bob, he bought a house for 300,000 and in 2021 as a rental property and paid $2,000 for closing costs. The house was sold for 900,000 in 2021. He spent 50,000 to remodel the property before he put the property on market in August 2021. Commission for listing the property were 55,000 and 54,000, and closing costs were 10,000, and he claimed 8,000 for depreciation over years. So how much is Bob capital gains? So I just plug in the number into the formula, but the only difference this time is I have the depreciation number, in this case, $8,000. So in this case, Bob capital gains was 406,000. Actually, his cost basic is 406,000. That cost basic, and his capital gains is his selling price minus his cost basic, and the capital gains in this case is 494,000, almost 500. But you know what? Doesn't matter, 500,000 or 100,000 or 200,000. He doesn't get to use the tax exemption. There's no tax exemption for rental property. So he has to pay 494,000. He has to pay property capital gains tax on this amount. This is a lot. So what do? Is there a way to avoid it? To avoid this capital gains for the rental property? Anyone? Yes, we do, right? You know, we do have a way to avoid this. We use what? 1031 exchange. Remember we talked about 1031 exchange because it's a rental property. If he doesn't do 1031 exchange, he had to pay capital gains tax on this $494,000 because this is his capital gains. So because he was able to use capital gains tax, okay, I mean you 1031 exchange, okay, so he can delay. And remember, he have 45 days to be in contract for the next purchase, and it had to be real estate. Okay, that's it. I hope you get that so far. Okay, I don't see any question. I'm not sure if there is any question. If no question, I move on to long-term and short-term. Okay, you can have question. Let me know if you have question. I don't see any question. I don't see any question. Okay. All right. Uh, I will go to we're done with 1031 exchange, right? We're done with the example. And now we go to the long term. What do you mean by long term capital gains tax? And what do you short term capital gains tax? So there's a definition right here. Refer to, short term capital gains tax refer to profits earned from the sale of the property that has been held for 1 year or less. So if you purchase a property and you sell it within 1 year, you fall into what called short term capital gains tax. But if you hold a property more than 1 year, more than 12 months, then you will fall into the category called long-term capital gains tax. Okay. So capital gains tax, um, the tax rate depend on your income level. Okay. The more income you make, the more capital gains tax you pay. By the way, the capital gains tax for a short term is much more than the capital gains tax for a long term. Okay. So you see right here, for people who earn in for a single for one person who earn an income less than 11,000, their capital gain tax will be 10% if they sell something like within 1 year. Sorry, I have to drink some water. For a couple who marry and file tax jointly, if they make less than 22,000 and they sell something within 1 year of, they buy something and they sell something within 1 year, their capital gains tax also 10%. Okay, for a whole family who income less than 15,700, their capital gains tax for short-term capital gains tax is 10%. And we didn't just go down and read it, but you look at the end of the table, at the last row, for the short-term capital gains tax, the maximum capital gains tax rate is 37%. And by the way, this table is up to date for 2023. So for people, so you look at this one, right? For people who make a lot of income, for a single person, and he make 500 up to $578,000 a year, his capital gain tax for a short term is 37%. You see that? You see that? And for a married couple who file tax jointly, if they make income up to $693,751, their capital gains tax for short term is 37%. Now I want to show you how much the short term capital gains tax is compared to the long term capital gain tax. Okay, so here you go. The long term capital gains tax. Look at this. The maximum tax rate is 20%. Look at the last row of this table. The maximum tax rate is 20%. The only thing you need to remember is to keep the property longer than 1 year. And instead of paying 37% of capital gain tax, you pay only 20%. And for people who make, for a single person who file tax by himself, and if his income is less than $44,625, he only he had he paid no capital gains tax at all. Is it so awesome? So somebody have very low income and they invest in real estate. My goodness. Awesome, awesome. And long term, again, what is the long term capital gains tax? You have to keep the property more than 12 months. That's it. And I think for real estate, we want to keep the property, long enough to make a lot of money, right? Um, and then for people who make from $44,625 to $492,300 for a single person, their capital gains tax for long term is only 15%. And for people who make more than 492,000 a year, the maximum capital gains tax is 20%. Okay? So far, you have been learning how to avoid capital gains tax for investment property forever and never ever have to pay it. Okay? And then for rental property. But for owner occupied property, remember, if you are a couple, you own a home together, make sure when your property value increase more than 500,000, go ahead, sell it because you get 500,000 tax exemption. Okay, 500,000 tax exemption. And in your lifetime, if you do it 4 times, you will have $2 million tax exemption. Hello, that is a lot of money. Okay. If you are an individual, you are a single person, you own a property, you live in it, every time you see your home value go up more than 300,000, go ahead, sell it. Because if you do that 4 times in your lifetime, my God, you save $1 million yourself from tax. So please remember these, talk about this to your friends and family to help them to keep a lot of money for themselves so you can all retire early. Okay. And we are about to be done with today's presentation. By the way, at Pacific Y, we do jumbo loan. We have very good interest rate for jumbo loan. We do conventional loan with 3% down payment. We do FHA loan for 3.5% down payment. We do mobile home loan. If you know anybody need a mobile home loan and need to buy a mobile home, we can help them too. And we still have the 30% down payment assistance. Whoever want to buy a house in Santa Clara County, remember, we still have this program. The county give them 30% for down payment. Okay, so somebody have good income but just don't have any down payment, the county will give you 30% for down payment assistance. We do construction loan. So if you have a house that you have a land and you need to build a home, you need money to build a home, we will help you with the construction loan. And for people who 62 years and older who want to borrow reverse mortgage is the mortgage that it's really easy to qualify. The interest rate is really low compared to conventional loan. You can do refinance cash out for rate less than 6%, and then you can. Oh, by the way, you don't have to pay mortgage payment for reverse mortgage, and then it's only for senior citizens, 62 years and older. And we have another loan program we call ability to repay. If you have $1 million in your bank account, you don't have a job, you don't have anything, you want to borrow $1 million loan, we let you borrow it. We don't care about your income. We have a HELOC line. We can help you to apply for a HELOC loan or a second mortgage. If somebody want to invest in real estate and there's no income whatsoever, we have the no ratio. That means no docs. We can help you to buy a home with no income document. We don't need income document, guys. Okay, we have hard money loan. We have 12-month bank statement. We have all kind of loan program here at Pacific Y. If you have any question, if you need me to help you, please let me know. I will be here all the time. My next class, I will talk about Prop 19, about property tax. I might touch on some little bit on tax on this kind of thing. But if you have any concern or question that you want me to help you, you want to have me to talk about something specifically, email me, text me. This is my phone number and my email address. You can request for a class. I will create a class just for you. Of course, I will invite people to join the class too. And if anybody want to attend my class this evening at 5 p.m., I will speak Vietnamese. It's gonna be more fun. It's easier for me, for everyone to communicate. So join me at 5 p.m. Vietnamese class. The same topic. We will talk about the same thing, but in Vietnamese. And if anybody's joining in late, you can always join my 5 p.m. class. Okay. So see you today at 5 p.m. if you want to see me again. Otherwise, I wish you a wonderful time with your family tonight. Enjoy your time and stay healthy. Okay. And I hope you can join me for other class next time. I don't see any questions, so I think we can be done by now. Oh, I see one chat. Thank you so much, MC. My appreciation. Thank you for joining. So I'll see you again, anybody. I hope to see you soon. And have any question regarding to refinance cash out, or get a pre-approval to purchase your investment, call me. Have any question regarding to 1031 exchange, call me. Question about capital gains tax, call me. Okay. But of course, you have a CPA, a tax preparer. You can talk to them as well because they are even better than me in terms of tax. Okay. Thank you so much, everybody. Talk to you soon. Take care. Bye bye.